seminars. Today we have a very special guest, Eddie Speed, and we will be talking about how to find a motivated seller in real estate. So before we get to our really important guest speaker, I am going to share a few slides about who Quest is and what we do, just in case there's a few new people with us that aren't as familiar. All right. Here we go. All right. So thank you so much for joining us. We're so happy to have you here. Sorry, I'm having a little bit of technical difficulties. It would not move for me. There we go. All right. So who is Quest Trust and what do we do? So actually, Quest Trust was built for investors by investors. It was started by two brothers, Quincy and Nathan Long, and they were actually self-directed investors themselves. So they built the business around what the client experience should be. So it really is all about the client experience. We have over 20,000 active clients all around the country. So no matter where you're joining us from right now, we'll be able to help you. We have over $2 billion in assets under administration. And we have, we need to update this slide. It is now $400 million in undirected cash. That is a lot of opportunity for using other people's IRAs to fund your deals or do promissory notes. So keep that in mind. And of course, our disclaimer, Quest Trust, this webinar, just like all of our other webinars, is for education purposes only. We do not give any legal, accounting, investment, or structuring advice. So please make sure to do your due diligence on your investments and the professionals that you work with. There we go. All right. So what is a self-directed IRA anyway, and why should you have one? So self-directed, honestly, is just a marketing term, and it really just means you are in the driver's seat. You get to direct us yourself on what private assets you would like in your IRA. So an IRA here is just like an IRA anywhere else. It's governed just the same. However, Quest has open architecture to have these private assets in front of in them, excuse me. So some benefits are diversification. So instead of just being able to invest in the market, stocks, bonds, mutual funds, now you have a platform to invest in things like real estate, promissory notes, private stock, oil and gas. We even have people with cattle in their IRA. So a lot of choices there. The tax benefits. We have tax deferred accounts or the Roth IRA, one of my favorite accounts. After meeting some qualifications, you can actually have tax-free distributions. Social investing, another huge plus. You can actually be funding projects in your own community and kind of watching that grow. And of course, this is another place for you to be able to shine and invest in what you know best. So if you do know a lot about a certain industry, real estate, oil and gas, what have you, this is a place where you can really use your knowledge to help you save for retirement as well. Oh, we're going backwards. Sorry about that. All right. So here are our 7 accounts at Quest Trust Company. You can see we have plans for businesses, personal plans, and our specialty plans. I'd love to tell you more about each one, but unfortunately we don't have time today. So make sure you're contacting your IRA specialist, and we'd love to tell you more about all of them. Here's a list of investment choices. These are the 3 main asset classes that our clients invest in. It's actually kind of a short list. A lot of things aren't even really listed on here. Oil and gas isn't listed. You can do wholesaling, options, all kind of things. So definitely check out your options there. So steps to purchase. It's actually very easy to open an account and get this completed at Quest. So 1, you would open an account here. 2, fund your account. We can help initiate that transfer for you. Locate your investment. So glad you're on our webinar to kind of help doing that. Complete our internal investment forms, and then we can go ahead and send the funds out to fund your transaction. This can all be done through paper forms or on our client portal. We now have the transaction tracker where you can do all of your investments online. We've actually revamped the whole client portal, and there's so much more you can do on it, so make sure you check that out. We offer endless education. We're all about that. That's something that we really pride ourselves on. That sets Quest apart. Like these classes here every Tuesday and Thursday at noon. Of course, we have our self-directed Saturday every Saturday at noon Central. Our YouTube channel is filled with all of these webinars. In fact, it's streaming live right now, so you can find all of our classes and other great information on our YouTube channel. We also have an education center and a blog on our website that's really full of really good information, some great interviews that Sarah, our moderator, has actually done. So make sure to check that out. And of course, our virtual networking happy hour. This was developed, of course, out of COVID, but it's really blossomed into this wonderful event. Now we can reach investors all across the country to kind of come together, network, share what they're looking for, put your information in the chat box, and kind of, meet offline and see if you can make an investment connection, excuse me. So the next one is actually this Wednesday coming up. I'll actually be the host. I'm looking forward to that. I do make it as fun as possible. So come have a glass of wine with us or a beer, whatever. We'd love to have you, but a great networking opportunity, great way to meet people and kind of learn more about the investments. So I'm almost done. I promise to get to our wonderful guest speaker. So it pays to have friends at Quest. We do have a referral program. So if you refer a client to Quest and they open the account, you can each get $25 credited to your account. Again, contact those IRA specialists. And we can help you with that. And this is our special for the month, a rewards program. So the deposit goes with, you can see on the chart, the qualifying deposit can earn you fee credits all the way up to $500. So when you open an account, make sure you use the code rewards21 to help you take advantage of this promotion. All right, so how to get in touch with us. We're actually very easy to get in touch with. The QR code actually really does work right there. Chat with us live on our website. If you have ever been to the website, the chat box popped up. It is manned by the IRA specialist and the transaction specialist. We are not robots. I get that question a lot. It's actually us. Call us 855-FUN-IRAs. I love our phone number. I think that's so cute. Or, of course, email us directly, iraspecialist@questtrust.com, or you can email me personally at nicole.baco@questtrust.com. All right, that is quite enough from me. It is now time for Eddie Speed to come on and share his wonderful knowledge. Eddie, please take it away.
How are you, Nicole?
I'm sorry?
How are you?
Oh, I'm doing great. Thank you.
All right.
How are you?
So you guys, I'm good. Are you guys ready to get started?
We are ready, sir. Take it away.
All right. So I'm going to share my screen. And I believe that's going to be the screen. And here we go. So I entitled this presentation, Identifying the Most Motivated Seller in Your Market. You see, we have a real estate boom. So with a real estate boom, does that mean that everything about residential real estate is booming? Or does that mean that there are voids in the market? And if there are voids in the market, can you solve the problem and figure out how to glue the solutions together? Because really, this is what the entrepreneurial thinker does, right? There's not a shortage of houses if you just call a realtor and you can pay enough money and overbid on enough houses, you can get stuff bought, right? But the truth of the matter is there is a gigantic void in the market, and this is a really underserved market. I have the good fortune to be involved in a number of high volume real estate masterminds. And when I speak to those audiences, I find that this is the one void that everybody recognizes, but how do you crack the code? So that's what we're going to talk about today, is to crack the code. So what in the world is a guy that's been in the note space for 40 years doing, talking about buying property? Well, what does NoteSchool teach and I'll just flash these across: buying property with seller financing, buying defaulted loans, buying performing loans, flipping notes for fee income, burnout landlord capital, which is really kind of how we fund our business, note leveraging techniques. Those are all things that NoteSchool teaches. But today, we're going to talk about one specific one of those, and that is buying property with seller financing. Why would the seller carry financing for me? What advantage could he have in doing that? And what would I do with it once I bought it? Who would do it? Why would they do it? And what would I do with it once I bought the property? That's what we're going to uncover today. So these are basically puzzle pieces. I look at this industry as entirely puzzle pieces. What is a note guy doing teaching real estate investing technique? Well, actually, I've helped real estate investors with financing techniques for a long, long time. I've set up systems for real estate investors, kind of like what I did for home investors a long time ago. I set up creative financing technique systems showing real estate investors, once again, voids in the market and how to solve and fix a problem of a void in the market. By the way, we have a gigantic void in the market, and there's a gigantic solution that most of the sellers of these properties do not recognize. They have a problem. They don't recognize how to fix it. And when you do that, you can change the scope of your business. So let's look at this house. We'll call this Anywhere USA. Now, this actually is a house in Dallas-Fort Worth, but we deal in assets all across the United States, not just in Texas, not just in Dallas-Fort Worth where my offices are, but we deal across the United States. And this can be really, I would call Anywhere USA, right? This house is bought. This is a hypothetical story. This house is bought in 2014 for $100,000. Real estate was cheap then, right? Real estate was on sale. Then the market value in 2021 grows to make this house worth now $250,000. Is that good? That's awesome, right? The gain when you sell it, the profit when you sell it is $150,000. Who can complain about that? What's the catch? This is a landlord property. This is a rental property. So when you gain that sale, guess what you have to do? You have to pay tax, right? And that becomes a gigantic problem. So we are targeting rental properties owned primarily by small landlords. Now, some of you in the audience may not be small, and this may be a gigantic problem that a lot of you would like to consider. You're not necessarily the target that we wrote the story about today, except that you own a rental with a high gain in it, and you want to figure out how to defer taxes. Now, this capital gains and locking in the capital gains rate, let's just call that a big deal. If you've been reading anything about new tax proposals, this could be a really big deal in the market. So let's look at kind of two ways that you might pay tax on a property. One would be the obvious. You sell the property and you pay capital gains immediately on the sale of the property. Now, I know that we don't have a live audience here today, but pretend that we did. And I looked out in the audience and I said, hey guys, how many of you would love to pay the taxes today? Raise your hand really high. Would you raise your hand? I doubt it. What if I told you that you could defer taxes on your gain for 15 years, for up to 15 years? You can. because the IRS allows this. The IRS calls it installment sales. And you could defer your gain for 10 years, 15 years, 30 years. You could defer your gain. So then you would be taking that gain over that whole period of time, a little bit every year. Now, in order to do that, what you're really doing technically is you are seller financing your rental. And you're not taking the gain up front, you're taking it over time. IRS will allow you to do that and do the installment sales method. Now, why does that matter to me? Because I'm a seller finance specialist. I've bought 50,000 seller finance notes. I've helped people with strategies for the smartest way that seller financing can help them. I didn't just buy their note. I helped them make good notes, and then I helped them do strategies around it. So this is a real estate investor technique, but I'm a very active participant in showing landlords how to do this. Now, another thing that I've done a lot for Quest is I've done kind of state of the industries. I did a state of the industry at the past QuestCon a few months ago. And I talk about what's great in the market and I talk about what's not great in the market. Now, there are some great things in the market right now, but there are some things that's not so great that I don't think necessarily everybody walking down the street is fully aware of. And the reason that matters is because that might produce an opportunity. Now, the stock market is surging. That's great. We've got raging residential real estate market. That's great. We've got record low interest rates. That's great. So we've got what's going on great. We've got some cool stuff. What's not so great is, let's call this below the surface, the iceberg underneath the water. What if I told you that 14% of FHA loans are not paying? It's fact. About 9% of all residential mortgages are not making a payment right now. Now, I know what you're going to say. You're going to say, Eddie, all of these loans are in forbearance. They just have an agreement with their lender. Well, let me just tell you that 2% are in forbearance, and the rest of them are something else. So, yes, there are loans that are in legal agreement not to pay, but most of them are not in a legal agreement not to pay. They're just in default. We got about 10 million renters behind $54 billion in rent. Here is the crazy thing. The most affected person in that whole cycle is somebody that we're going to target as our customer. Small landlords are suffering way more than professional landlords. Another fact is about 35% of the people that could get a mortgage before the virus cannot get a mortgage today. There is a credit crunch in the middle of a housing boom. What? Yeah. There's a credit crunch. 35% of the people that could get a mortgage before the virus can't today. Opportunity. I hope before you leave here today, you're going to be 100% clear that this is not bad. This is an opportunity. Now, for those of you that aren't interested in opportunities, you can save the time. You can leave early, because we are going to focus on solving a problem that I discover most people in the real estate investing community do not know how to solve. Creative financing, giving a tax advantage to a small-time landlord that is suffering in a market condition. If you can solve that problem, you can solve a big problem in the market. So, because of the market, it's very hard to buy and it's very easy to sell. Usually when I deal in distressed markets, real estate is dropping in value and it's very difficult to sell real estate. So if you can take a perfect, great market, but find some turmoil in that market and solve a problem that other people don't know how to solve, and it's equally great for you to go sell because there's such a demand for properties and there's such a shortage of people that you're solving a problem for, and there's a shortage of the traditional market is solving a problem. That's kind of the perfect storm. Let's talk about residential rentals, 1 to 4 family. Who owns it? Where are they in the market? And you may be surprised. 72% of these properties are owned by people that own 1 to 5 houses in their individual name. 1 to 5 houses in their individual name. They're not big guys. They're little guys. They're small operators. They're small-time landlords. 16% are owned by limited partnerships. REITs and corporations own a sliver of the market, call it 2%. And then other entities that own properties own about 10%. So they represent some percentage of rental ownership. But I have people tell me all the time the hedge funds own all the residential rentals. Well, these are the stats. This is from Urban Institute. So you can draw your own conclusion. I say the property is dominated by small-time landlords, right? This is a crossroads that, if executed correctly, I believe is a giant opportunity. The market's big, the pain is high, the strategy that we're teaching is not well understood. If you can solve this problem, you've cracked the code. So it's take an opportunity this way, a missed opportunity the other, you decide. I refer to these landlords as hobbyist landlords. Now, there's no intent of being of making fun, but it's the reality. Their hobby. They bought a few rentals, 1 to 5 rentals, because they fell in love with HGTV and they're like, oh my God, if Chip and Joanna can do it, we can do it. And the next thing you know, this has become a gigantic trend in the market. And there's been a gigantic increase in rental properties owned. But the giant increase, I know that, Wall Street Journal, a lot of those guys sound like the hedge funds are the only guys playing this space. That's not true. The biggest giant move in the market are small-time landlords, ones that own not many houses, and a lot of new investors coming into the market. The guys that have owned rentals for a few years, many of them found out that their rental property was more of a job than they were thinking it was just an investment. Just a reality. How many of them self-manage? 14.3 million of these, about 17 million single family, 1 to 4 family, 1 to a single family house up to a fourplex, they self-manage. They didn't hire a professional management company. Honey, we can do it ourselves. Now, I'm an entrepreneur. I'm a deal maker. I view everything that I design around solving a problem that the market has that I'm confident I can solve, that other people aren't solving well. To me, that's the perfect strategy to go pursue. This market right here has a problem. Their self-management is not being good to them. Now, I'm not saying 100%. You very likely may fall into that category. You may say, well, my rentals are fine. But you see, there's 14 million people in here, and not all of them are going to say that things are great. Millions are going to say it's not great. And there's been a lot written about it, a lot. Another interesting fact is of these small-time landlords, 60% of small investors don't have a mortgage. No mortgage. They're free and clear. Now that's interesting, because that means if I wanted them to carry their equity and finance it over time, they have equity. Is this making sense? So tax deferrals for capital gains, I can deal with a free and clear, or I can deal with partly leveraged. Let's say they have some debt against it. I like to call it 30% or less. So I'm chasing now a very defined sliver of the market. Landlords, small-time landlords, high equity, all equity. Now I'm filtering it down to a list, right? And I know their problem. I'm targeting people that the market has been good to them. The appreciation in real estate has taken their values up. Now, there could be an argument, yes, Eddie, but real estate is continuing to climb, and let's just be fair about it, Eddie. The trees are going to grow to the sky. Well, there's also another theory that says we are in a boom market, and that the appreciation that we've experienced, by the way, a result of listings of houses, may not continue. You see, there's about 8 million mortgages aren't making a payment. So I think we better talk about those, right? We might want to talk about those loans in the market and how they might affect. So this hobbyist landlord, I say it may not just be the hobbyist landlord. It could be any landlord that decides they want to reposition themselves from being a landlord to now shifting and being the bank. They have the market has been good to them, but deferring taxes would be the cat's meow. Now let's talk about who this is and how this works. So the seller of the property, let's call it the hobbyist landlord, sells a property to you, a real estate investor, right? You're the buyer, and then you sign a note. In other words, you didn't pay them all cash. You sign a note. Now, generally, we think of the bank having the note, but in this story, the seller of the property, the hobbyist landlord, then they become the bank. They're carrying financing over time. Now, once again, we've pointed out an incredible tax strategy that they probably don't know about. Their accountant may know about it, but the odds are, my experience, they've never mentioned it because they're not really a specialist real estate accountant like some of you may deal with. And then you're making payments to this seller of the property. He was collecting rent. Well, maybe he wasn't collecting rent. He was wanting to collect rent. Now, all of a sudden, he can collect payments. Now, there are workouts that I have all along the way, including eviction and moving the tenant out and all kind of things that are part of this story on a deeper level. So we've solved the problems that need to be solved to make this doable and scalable. Let's just say the property sells for $200,000 and you pay $20,000 down to the hobbyist landlord. You're the real estate investor. And so now all of a sudden the hobbyist landlord sells it and you make a down payment to him. First of all, how are you going to get your money back and how are you going to structure it? And so the idea is, what are you going to do with it? Okay. You can certainly buy it on terms and use it as a rental. And there may be cases where you choose to do that. You can buy it and put financing in place. Let's just call it soft terms of financing that are way more favorable than a traditional bank or mortgage company. And you could just flip the house to somebody else. Those are options. What else could you do with it? Well, you could buy it with financing in place and then resell it and offer financing to your new buyer. You could do seller financing 4.0. Now, let me say this. If I have any influence in the market, is I am about smart seller financing, selling really good properties to good buyers. Now you own a bank because you own the paper and you're getting paid back over time. You own the mortgages. So I don't want to go sell substandard real estate to substandard buyers, because the likelihood is, and I've been in this business now for 40 years, the likelihood is that it won't be good to you a long time in the future. The paper that I'm describing to you, the mortgages I'm telling you that you could structure, will be good to you a long time in the future. There's seller finance, there's smart seller financing, and there's other seller financing. I want to help you with the strategies that I've experienced the most success with, which is the seller financing 4.0. Now let's go back to this other thing of who you would sell to. We call this person the penalty box buyer. It's a hockey term, right? The penalty box buyer. And why do they exist and where are they at? Well, they are in huge, huge supply. So let's go back. Let me pull my pencil out here so I can do some marking for you. Call this the beginning of the market. So February 2020, the market said this many people can get a mortgage. I'm going to call this right now, call it 1,000 people just for conversation purposes. 1,000 people could get a mortgage at that level. Now here we are, and these charts are always a month or two behind, but we're here, and this many people can get a mortgage. That's down about 35%. So now go over here, 650 people qualify for a mortgage. Now, you didn't misread that. That said 6/1 of 2021. This has all been a housing boom. And look what happened to who could get a mortgage in the middle of a housing boom. In the middle of a housing boom, this many people couldn't get a mortgage. Now, you can look at that and say that's terrible. What I look at it and say is that is opportunity. If the conventional mortgage industry won't make them a loan, I will be glad to seller finance them. Now, by the way, I may not seller finance all 350 of them, because maybe there's some people that had something dramatic happen to them in the virus that hasn't now. But the credit standards now are unbelievable. You know what the average credit score is for like an FHA loan? It's like 750, 760 average. So this credit crunch that's happened because of the virus does not line up with the housing boom. If it's easy for me to sell, and there's a huge amount of people that's been left behind in the mortgage industry, reselling the property makes perfect sense to me. I hope it does to you. Here's another data fact. This is from Ellie Mae, by the way. The average loan to value. Now, by the way, this is not for refis. This is only for new purchases. The average loan to value on a conventional mortgage is 81%. Well, if you inverse that number, what you know is the average down payment that people are making to buy a house, the average down payment. And this does not include the overbid portion, the portion they're paying at over list. This is only for the original amount. Average down payment is 19% down. So you can sell a house for a gigantic down payment to a really good qualified person, way better candidate pool than we would have had 2 or 3 years ago with seller financing. Now, all of a sudden, you've glued together a heck of a strategy. See, when third-party lending is really good, when it's really easy to get money, creative financing is a sliver of the market. Some people do it. Eddie Speed and some of those, Quincy Long, Nathan Long, some of those Quest executives, they do stuff like that, but most people don't need it. Right? When the virus came along, all of a sudden, we had a scarce money scenario, a credit crunch, and all of a sudden, seller financing is a strategy that comes to the market. Offering seller financing became a puzzle piece that was a very effective solution. And who are you financing? The old penalty box buyer. Not somebody with bad credit and a sad story, but somebody that really the mortgage industry left behind. So we talked about our buy. Let's resell it on a wrap note. We resell it for $225. I didn't buy it at a huge discount. I get $45,000 down, which is consistent with the down payment numbers that we're discussing. And I finance $180,000. Now, here's what's interesting. I bought it and I owe $180,000, and I sold it and I'm owed $180,000. Well, Eddie, you're not going to make any money. You're going to break even on this financing game. No, because the terms of my buy are not the same as the terms of my sell. Now, I'm going to make $25,000 at the closing. That's transactional money. That pays the overhead. That does this. It does that. Now, I'm going to resell it on a wrap note. Remember my penalty box buyer. And now I've got my penalty box buyer, right? My hobbyist landlord is the seller. He's up here, okay? It goes through the real estate investor here, and then they resell to the penalty box buyer. He has ownership of the property. He signs a wrap note. So that means that they have a proper mortgage against the property. The original hobbyist landlord has a first mortgage in the safe position. There's a wrap note on top of that. So the bigger payment goes to the real estate investor. But the real estate investor has an obligation, moral and legal. He must make the payment that he's promised to make. His bank used to be the landlord. Now they're owner finance. So now they're the bank. and a smaller payment goes to them. And by the way, remember, they're getting a check every month, and they're not getting a check every month in their rental situation. It's a win-win for them. They deferred taxes and they're getting the cash flow that they wanted. So the buy side, we structured this at 2% interest, which I think is very realistic that a hobbyist landlord will carry that. That is a proven structure that we've made work many, many times. Then we're going to resell it on the wrap note with 45,000 down. So remember, we're making a pretty good spread up front. Plus, we're going to carry it at 7% interest. And that 7% interest, about 30% of the mortgage industry today are non-agency loans, non-Fannie Mae, Freddie Mac, FHA, VA. These are called non-QM loans. QM stands for qualified mortgage, and that's a normal rate for a non-QM loan. So I'm not financing this guy in some ridiculous market condition that a rate higher than the market. This is the market for that type of a loan. Now I'm making a spread between the 2% interest I'm paying and the 7% interest I'm collecting. I'm really doing what your bank does. Your bank does this. They take your money and don't hardly pay you anything for it, and they lend it to me and they charge me more money. So you're making your real estate business, even your self-directed retirement account, a bank. You're collecting $1,200 a month. That's your wrap payment. Now, this is just principal and interest. This doesn't include taxes and insurance. And then your underlying payment is $665. So your net income per month is $535, or per year times 12, you're making $6,500. You made $25,000 up front and $6,500 for, call it, the next 20 years, next 30 years. So there's your down payment. There's your first year's spread profit. So in the first year, you're at 31,000, and then you got 30 years of income at a pretty good clip. You bought a property at pretty much retail, and it made $218,000 in income. You didn't make money on the buy low, sell high. You made money because of the way you structured the deal. You found a customer with a rental that they owned, that they found out that they weren't good at managing. They had an income tax liability because the market had been good to them. Their tenants may not have been great to them, but the market was good to them. You showed them a strategy they wouldn't have thought of. You solved a problem. You gave them long-term income on an investment, which is why they originally bought the property to start with. And you have a huge pool of these buyers. Call it 17 million. There's not a shortage of people that need the problem solved. There's only a shortage of people that know how to solve the problem. So you're the seller financer. And what you found out is you're building your own bank. You can do this in your corporate entity. You can do it in your retirement accounts. You can do it however that looks for you. It isn't one note that makes wealth. It's a duplicatable process with a big pool of people that need a problem solved. So I told you earlier that NoteSchool trains people to do a lot of different things. So I want to give you a resource that you could then come back and come to us and learn different things. We have an excellent, inexpensive one-day class, and we're going to show you non-performing notes. We're going to show you this more in depth into this strategy I've shown you today, we're going to talk about how to buy notes. We're going to talk about leveraging techniques, even with a Roth IRA account where you can use leverage. We're going to show you some more tools because really what we found out in this industry is we get paid the most when we're creative, even with our retirement account. And so that creativity becomes a real factor. Nicole, I promised you that I would leave you a window to answer some questions.
And you did. And we have some questions for you.
Okay.
All right, here we go. I'm just going to go in order. So number one, what happens to deferred capital gains tax when the seller, original owner, dies prior to the full term?
Well, it becomes part of their estate. So the income, remember they're getting income, right? They're getting income. So they're paying capital gains on the income. So they're accepting the money in future years. They're paying taxes on the money in future years.
Okay. Thanks.
Yeah.
The next one, there was a slide that you had earlier in the presentation, and it was the what's great, what's not slide. It was the iceberg, I believe, but it said, how are the 14%, 9%, and 2% figures obtained on the what's great, what's not slide?
We scrape data from a lot of sources. CoreLogic, Black Knight are probably the two best. There's no inconsistency in the marketplace. We have a NoteSchool TV. We do it every Wednesday. And the last week of every month, we do a market update slide. And we have a lot of these reports. Black Knight produces what's called the Mortgage Monitor Report. And it's an excellent report that has all this information. We fully understand that most real estate investors are unaware of this. Trust me, I know pretty well, probably 65% of the top 500 house buyers in the United States. And I frequently find myself telling them data that they're like, oh my God, I didn't know that. So but these are, CoreLogic and Black Knight are probably the two best known sources. Urban Institute has a lot of data, and they print a lot of data related to, like as you saw me, the small time landlord variable in the market. So it's not a mystery. But I would say to you that I think I have a long-standing reputation with Quest that I've used source data. We're not making statistics up, but we use source data in the marketplace.
Of course. Okay, thanks so much. The next one is, why would the hobbyist landlord agree to a 30-year agreement? Would this work for a shorter term, like 10 years?
It would. You might need to do a balloon because you need to make sure that when you sell it on a wrap note that your underlying debt service has somewhat of a matching amortization of the wrap note you're selling. So one of the ways you could do it is you could do it on a 30-year amortization, but put like a 10-year balloon in it. Now, I have a lot of theory about how to do that. And in a more advanced training, I can show you a technique where the seller most always will carry a longer term, but it's a little more of a story to get there and how I would reposition that.
Okay, perfect. Fair enough. Thanks. Let's see. I should have put my contacts in. If your end buyer doesn't pay, you foreclose on them, correct?
Yeah.
Okay. All right.
But the performance characteristics of this type of loan are going to be very different than the performance characteristics of seller financing, where they financed a lesser quality of a property and a lesser quality of a borrower. I'm not saying they can't default, but I'm saying I'm not creating problematic loans.
Okay. The next question is 2% interest rate industry standard for seller financing. It seems too low.
What's industry standard?
I was just reading the question.
We price 3,000 to 5,000 owner finance notes a year in my shop. The average interest rates for mom and pop seller financing is probably in the 3% range. So we see from market evidence that not real estate investors, but just mom and pop hobbyists, let's call them, they finance at close to bank rates. And right now bank rates are around 2%. And we think we can sell that more often than not.
Okay, perfect. This one is from Robert Keller. Can you negotiate a lower payment to the estate if they would prefer a lump sum, assuming the owner dies before the installment sale concludes?
Yeah, so we are definitely going in deeper level training. We're going to like unfold the curtain of what these terms are. And there are definitely terms that I would bake into every transaction. And one for certain would be a first right of refusal. If they ever want to cash the note in early, that they would have to come see me.
Okay.
I'd buy my own debt at a discount.
I'm sorry?
I would buy my own debt at a discount.
I see. What happens if the buyer, unfortunately, had a divorce and wanted to sell the house? I'm guessing if this is like in a wrap situation.
Mm-hmm. Wouldn't be any different than paying off a regular mortgage.
Just go through the.
No, it's a closing. I mean, we've owned thousands of notes, and so on a frequent, when you own thousands of notes, I mean, some house sells and the title company asks you for a loan payoff, just like they asked a traditional mortgage company. Doesn't mean they can't sell it.
Okay.
Yeah.
What about repairs needed between original owner and buyer? What about appraisals for the property? I'm assuming they're asking like who would pay for that.
So right now the market is so wide and so big, we're not buying heavy rehab. The rehab market today is very difficult to manage. It's very difficult to budget. It's very difficult to run a time frame. And what we find is that finding the burnout landlords, honestly, are the least difficult part of the situation. So we can be fairly picky in the properties we're buying, particularly focused if we're showing them a strategy that defers taxes. And by the way, nobody else can show them how to defer taxes. It's seller financing that allows them to defer taxes.
Okay.
Yeah.
Let's see. Can you negotiate a lower payoff if the estate beneficiaries prefer a lump sum payment before the installment concludes?
It's the same question somebody just asked.
Okay.
Buying your own note at a discount.
Okay.
You are looking at a man, you're looking to the eyeballs of a man that's bought 50,000 notes at a discount. It has crossed my mind.
Of course. This is, are you marketing with mail or I guess, how are you marketing is really his question.
Yeah. The students that we have doing the best are just using a simple mail strategy.
Okay. And I've had.
It's so easy to target the list.
And then I've had several requests for your contact information. So if you wouldn't mind, if you have a slide with that on it, that would be great. Or if you just want to say it out loud.
They should be looking at that right now. NoteSchool.com/quest.
Okay.
And when they go to that page, there's going to be all kind of different ways they can reach out to us. They can reach out to us in email. They can reach out to us in a phone call. They can go get in for more information about a one-day class. So I've sent them to a good page that has a lot of options of how we can help them next.
Perfect. Well, thank you so much. I really appreciate it. I do have one question myself. What would your golden nugget piece of advice be to people that are kind of just starting out in this arena?
Well, I will tell you this, that I am around on a regular basis a lot of the very high volume operators, probably you call it the biggest house buyers in most any market, right? Because I'm involved in several real estate masterminds, Collective Genius, Investor Fuel, Boardroom, several of those different masterminds. What I found is the common theme right now is the really big operators who have very sophisticated marketing and very sophisticated negotiation and sales cycle strategies. They're doing good buying houses right now. The small operator, because his strategy was essentially only to try to go buy at a discount and flip it to somebody else. I find that they're not doing so good. So if you're entering a market thinking there's no speed bumps ahead, that's not what people that are in the market are experiencing. Mm-hmm. So the catch in any market is like, what do you do that makes you different? Like what is your special sauce that positions your real estate investing? And I've fully today tried to lay out to you a simple, executable strategy. Now you're going to need to come to NoteSchool. I'm going to say that, but this is the what you do, and then let NoteSchool help you with how you do it.
All right. Well, fair enough. Well, thank you so much for joining us today. We really appreciate you being here. We had, lots of questions, lots of audience involvement. So again, thank you so much for being here. Thank you for such great information. To all of our attendees out there, thank you so much for joining us. We will have another class on Thursday at noon Central. I will put my contact information in the chat box one more time. I put Eddie's in there for you. All right. I'll leave that up for just another second so everybody can get the information. Okay. All right. Well, thanks, everybody. I hope you have a wonderful afternoon, and we will see you back for another class on Thursday at noon, or you can come join our happy hour tomorrow night at 6:30 Central. Thanks so much, and have a great day, everybody.
Bye-bye. Thank you.
Bye.